Hey y'all, welcome to this week's episode of Financial Freedom in Medicine, a podcast where we discuss financial literacy for those in the healthcare industry. If you're not in the healthcare industry and you're very new to the financial world, this is also a perfect podcast for you because we're really starting out from the beginning. This will be our finale for our mini-series on stocks. Last week, we went into a deep dive on a stock called Costco, which has the ticker symbol COST. Feel free to go back to our previous episode to learn about that. If you are awesome listeners, like what we did last week, or you like what we're doing this week, we'd really appreciate a 5-star review. It helps our podcast become more visible to more people, which will enable healthcare professionals to gain knowledge in the world of financial literacy. Also, be sure to hit the subscribe button so you don't miss any of our new releases. This week, we're going to wrap up stocks with the question you all probably most want to know, which is how do I get started in stock investing? Before we do that, I want to introduce my three wonderful co-hosts, MD, Akshar, and Mickey. How y'all doing?
Fantastic.
Amazing.
Pretty good.
Well, this
Great
third
stuff.
time's the charm, Mickey. We finally got your video working. We've been going at this for about 30 minutes, but we're good to go. So this will be the first week that we post video on the podcasting apps. We're excited about that. MD, I'm going to hand it off to you. Can you get us started in how does one get started in stock investing?
Okay, yeah, that's a very good question. But before we get into that, I just want to make a quick disclaimer for all our listeners and viewers this week, since we're showing face today. But I want to reiterate that we are not financial professionals or advisors, and we encourage all of you to do your own research so you can make informed decisions. Learning more about what we speak of is literally just a click away. A YouTube video, Investopedia, Wikipedia if you want to learn more about the history as well, or other websites. But just be careful that all free resources are not positive with the generosity of knowledge. There are people out there we will get you a very big return, get rich quick scheme, and a few Ponzi schemes here and there, and courses. People love selling courses that they explain will make you great returns, but be wary of that. Make sure you get them vetted. Make sure you get great references and make informed decisions. I would say practice is also a very big proponent on becoming successful. There are simulators that are out there that will allow you to invest fake money and put it into your favorite stock after you've done a deep dive on them, see how they trade, buy, sell, ETFs, some shorts, some puts, some calls. Just work your way around it, practice a little bit, and see how you become successful, what your trading strategy is. There's also a few other platforms, once you get better at this, that you can start investing real money into. And I think Mickey's the best individual to tell us about those platforms. What do you think, Mickey?
Yeah, I can take a stab at that. So there's things like Investopedia or MarketWatch, which are great simulators. One of the more famous ones is called Thinkorswim through the TD Ameritrade platform. And you can use this thing called paper money, where you can learn how to input orders to buy stocks, sell stocks, or even do some short-term trading with options. And this could be a very good way to get well-versed before you do real trading, because with real trading, you can lose a ridiculous amount of money and very quickly if you don't really understand how the short-term trading works. So it's a great way for you to practice with the safety of paper trading or fake money without using real money, and allows you to get the ropes. So like Remy said, practice makes perfect. I know each of us on this podcast can agree we learned about most of what we talk about on these episodes from experiences applying what we learned and practicing it first. So the first step to achieving that financial freedom is to give it the old college try, but try it in the simulator first.
That's a great point, Mickey. If you are investing or trading, which I would argue is not necessarily investing, if you're short-term trading, you can lose ridiculous amounts of money very quickly. So definitely do not ever try a short-term trade before you've practiced it a lot in paper money accounts, like something like Thinkorswim. But you gave us a lot of great tips on how to do paper money. Akshar, how could I start buying stocks if I want to actually not use paper money?
Yeah, so when you decide you're ready to take the training wheels off, you can get involved with the stock market through tons of ways. The main way for people like us, i.e. retail consumers, is through brokerage accounts that we can simply just sign up for online. Big ones like Fidelity, Vanguard, Charles Schwab, Robinhood, E-Trade. There's so many more, but these are just the first ones that come to my mind. Basically, how these work is you sign up for an account, simple as that, like you do anything else, and you're going to deposit money from your bank account into this brokerage account which will then turn around and allow you to buy and sell stocks that you have on the account. And then depending on the type of account that you actually have, selling stocks can incur a tax bill. So be mindful of what you trade when you trade it. I would just recommend starting out by picking one brokerage account and just seeing how you like it. It doesn't necessarily matter which one you pick. They all work the same. But for beginners, there's for sure ones that are more user-friendly than others. I personally really like Thinkorswim and Fidelity. Robinhood is also a great way to get involved. And then another way to get into brokerage accounts and stock trading is retirement accounts and tax advantage accounts like 401ks, IRAs, HSAs. I'm sure you've heard of all these. We'll probably do a whole other separate video for all of those types of accounts because they all provide certain tax advantages. Depending on your situation, one might be better for you than the other. There's even accounts called HSA accounts that are meant for savings for healthcare. And these accounts, while you have tax advantages in the gains that you make, if you try to take out that money before you're supposed to, there are big time penalties involved. And so you don't want to do that. But that's why we're going to make a whole nother video on this stuff so you guys know what you're doing here.
And just to echo what Akshar said, 401ks, IRAs, Roth IRAs, HSAs, there's a fantastic way to grow your money. So stay tuned. We're definitely going to talk about that a lot more in future episodes. So now you have your trading account, you deposited money into this account, and you want to invest. The next step is to determine how you want to allocate your money and what strategy you're going to be investing in. So in previous episodes, we talked about certain ways you can break up your money. In our diversification episode, we talked about the possibility of, let's say you have $100,000 to invest. You can put 25% of your money into real estate, so things like houses, apartments, or even real estate stocks, 10% of your money into bonds, 10% into treasuries, which are U.S. government-backed bonds, 45% into ETFs, and you could split that 45% up into an X percentage amount into the tech ETF, or another Y% into the real estate ETF, or consumer staples, industrials, et cetera, et cetera. And then you could invest that remaining 10% into a riskier company that you see taking off. So you've done that deep dive like we talked about with Costco. You know the growth trajectory, you're really passionate about this stock, you're really bullish, and you can put that last 10% into that one stock. So you get that exposure, but you're not putting your whole portfolio into it. So you're diversified. And just a disclaimer, these are just random numbers. There's no rhyme or reason to these numbers. We just want to display our point about how to spread your money out into different types of investments. And a really important point to make is that these percentages will change as you age and you want to change your risk profile. So you might, let's say, want to switch out of stocks into bonds, for example, as you get older, because you care less about growth and more about preserving your money as you get older. So
Mickey, can we just stop there for a second, maybe talk about that? Because I think you have a pretty good handle on that. Let's say you're starting out in stocks. Most likely you're not going to have $100,000 to invest up front. So you may not be able to allocate your money in ways like this. I mean, you might have a couple $100 that you start out with. But as you increase the money that you have, it probably is important to diversify. But let's say you do end up diversifying and then down the road you're in stocks and you want to go into bonds. Why would you want to go more into bonds as you get older? Maybe you can just remind our listeners. I think we may have talked about that before.
Yeah, no, that's a great question. So for us as young people, we have the benefit, as what Brennan likes to call his most powerful tool, time, on our hands. We have decades and decades of time to invest that money, to let it compound, Brennan's magic buzzword, to help our money grow forever and ever. But as we get older, stocks are a lot riskier than bonds. Bonds are a form of debt. So we can invest in stocks now while we have the time to, let's say there's a bad year, the market goes down, we can handle those risks now because we have the time to make that back up. But as we get older, we want to put that money more into bonds because bonds are less risky. So now that we've accumulated all this wealth, we can now put it into bonds to preserve that wealth and grow it just a little bit going forward. So that way we have that money for retirement. And if there's a risky year, we're not as affected. So we have that money for our retirement needs and we're not losing it all in 1 year right before we retire.
Perfect. Okay, that makes a lot of sense. So I said you might not have $100,000 to invest. Maybe you can just talk a little bit more about that. Let's say you start out with less.
Yeah. So you may not have $100,000 to invest. I wish I sure did, but I don't. But you might say that you can put all your money into stocks right now. But as you grow, you want to be cognizant of where your money is located. So if you're going to invest in all stocks, your next step is to determine what types of stocks you're going to invest in. So we talked a decent amount in previous episodes about mutual funds versus ETFs versus individual stocks. If you're not going to take the time to research and understand a company deeply, it might be best to go with a broad array of companies in something like an ETF. that hedges your risk, gives you that diversification very easily. There could also be a combination of ETFs and individual stocks. If you only have a little bit of time to research a few stocks, you might do a bunch of ETFs and then add a few stocks you're really passionate about. But the most important point is how you allocate your money is totally up to you.
Yeah, that's a great point, Mickey. It's not for us to decide how you allocate. I mean, that number is going to be different for every individual, regardless, because there's so many factors like A, money, B, what kind of growth I'm looking for, and C, what I think is best for myself. So that number is going to be different for everyone. On top of that, this is also something you could talk about with a certified financial advisor, and they would probably give you arguably way better advice than what we're giving you, and actual financial advice at that too. But Ramiz, I've read a lot about robo advisors lately and margin accounts. Let's tell the people about these too.
So those are pretty cool, not for the faint-hearted, obviously. And robo-advice is a massive, massive field that's really upcoming with AI and just technology advancing. I'm going to get into that a little later, but let's first target margin accounts. Well, we're basically trading accounts, and you guessed it, it's based on margin. That means you basically trade on borrowed money, aka a loan. Now, that because you're trading on a loan, it can dramatically boost your returns, but just as the seesaw goes up one side, it also comes down the other side. So your risk and the amount of loss you have is also greatly magnified. For first-time investors, including us, margin accounts are a little risky. They do have a very strong downside if you don't know what you're doing. And you're trading with borrowed money. That means you're trading on money that's not yours. Therefore, if you lose that, you don't just lose that money, you have to also pay back that money to the financial entity or person you borrowed it from. A quick example that would allow me to put this into a conceptualization. Well, do you guys want to help me with that? Anyone want to help me, like, put an example in?
Yeah.
Yeah? All right, okay, let's
So
do it.
let's say
How about,
you.
yeah, how
No,
about
you go for it.
I'm gonna build on it, and then you could like be the opposing party. So let's say a loss without margin would be, let's use the 100 shares of $50 stock, right?
Yeah. So if
So
I spent 5 grand on
that
100
means,
shares, $50 a piece, and then
yeah,
let's say the market went down, right? And I had
to
to
30.
sell and I needed
Let's
to
say
get my money
$30
out.
a share.
Yeah. Now I'm only getting 3,000 back. My loss is 2 grand,
Correct. Okay,
right?
now let's switch it up with a loss with margin, all right? Now we do the same example with 100 shares, $50 a stock. We've spent 5,000. I buy another 100 shares on margin, which I is basically $0 because I'm using borrowed money. I haven't really spent that money yet. But when the stock falls short to $30 and now I have these 200 shares that I sell, I'm getting 6,000 back. First for the 100, which is at 3,000. Second for the 3,000 from the other 100 that I bought. But in total, if I had to really put everything together and add interest that we didn't add initially, my total loss is actually 4,400, accounting for interest, let's say assuming $400 on the interest. The total loss comes down to 4,400 instead of the 2,000 that we initially had on the normally traded shares. So it's a little risky because you are playing with borrowed money, you are playing with interest, you are playing with a fluctuating market. But like I said earlier, practice makes perfect. This could be something you could use on the simulator, see if you really understand it, if you can play with it. And if you do, send me a text. Like maybe we need to speak. If you really understand that, you can help me out with my investments. Did you guys understand the margin accounting there? Any questions, clarifications needed?
I think I understand that. So essentially, what you said is you bought $5,000 worth of stock, and
Yeah.
it was $100. You bought 100 shares of a $50 stock. It went down to $30 a
Mm-hmm.
share, and you still have that 100 shares. So it went down to $3,000. So if you were to sell that, you lost $2,000. Is that correct?
Correct.
Without margin.
Correct.
If
Correct.
you sell it with margin, you don't lose 2,000. You lose 4,400 based on interest, et cetera, et cetera.
Correct. But
Got it.
if it gained, you would have gained a lot more as well. I just explained the downside of something just
Got
to
it.
maximize or like magnify the risk more than the gain. I think it's very easy to say we would have made $100,000 or whatever or so, but it's also important to signify and encapsulate the negative downfalls to this as well.
Yeah.
Yep.
And I want to jump in
Okay.
and add, just
Yeah.
like Ramiz talked about how you can use this to gain a lot of upside, but there's also a lot of downside. For a lot of first-time investors, it's better to shy away from this kind of stuff because if
Yeah.
stocks go against you, it can spiral out of control very, very quickly, and you'll be owing people money that you don't have. So it's best to reduce that risk all to begin with and just not mess with it in the first place until you really understand how it works. Like Ramiz said, practice it, get your investing style down, and then kind of jump in very small when you do.
But okay, moving on to something cooler, robo advisors. Now, this is something I personally looked into when crypto was booming. There was these algorithms, they were named AI, so it was really cool and poppy. But they're basically these simulation types of algorithms that they customize towards your preference and your trading strategies and your trading patterns. You allow them to basically make these small trades for you. They buy, sell, as the word says, robo advisors or robo traders. And this algorithm can simulate or encapsulate what you do on a day-to-day basis or on a weekly, monthly, yearly basis. And they make those trades for you to come above some margin or some percentage. They're not always successful. You cannot just rely on this algorithm to say, okay, here's $1,000, make me a millionaire by the end of the year. It doesn't work like that. It is pretty conservative. It allows you to be on a very standard range of what you've invested into it. And they're basically automated financial algorithms that provide trading advice. They show you stock picks too. This is just the robo advisors, not the robotic algorithm that allows you to invest. And they auto portfolio rebalancing and tips cater to your profile and trading preferences.
So, MD, these robo advisors sound pretty fantastic. Are there any downsides specifically that you know of?
Yeah, Brendan, there are some downsides.
Ramiz. I got
Yeah.
this. I got this one. Let me
All
take
right.
this
All
one.
right.
All
All
right, let
right.
me take this
Okay.
one.
Run it.
So, like Ramiz was saying, robo advisors are a great way for rebalancing because it helps your portfolio stay diversified because they're automated. But they've been designed for a one size fits all approach, which means some of the recommendations may not be optimal. There's no human being behind it who's offering you truly personalized investing advice to your own personal needs. So, it's important to fact check and do your own research when looking at robo advisor recommendations to make sure you like the recommendation and it fits with your goals. Moreover, the advisors can vary depending on the brokerage you use, so it can likely lead to different results based on the trading platform you're using.
Okay. Okay. Mickey, I'm with that. You did your
Yeah,
research.
I try my best. I try my best.
Yeah, that was pretty good. Okay. So guys, we talked about where to trade, how to get info. But when I go trade, I see all of these different types of orders. Sometimes it could be a little daunting to figure out which order I should choose or which ETF to buy. And I think Akshay, we were speaking about this last time when we were doing some research, and I think you had a good take on it if you want to go on with that.
Yeah, for sure. So there's a few different ways to buy and sell stocks depending on the price or the timing of when you want a trade to happen. But for the majority of us, we're just going to be using the simple two buttons that say market buy and market sell, which basically just means if we put market buy, we're trying to buy whatever stock we want at the market price during open market hours. And then for market sell, we're going to use that button most likely when we're trying to sell a stock at the market price during open market hours, right? And then there's other choices that come in. So now we're going to have things like limit sells, market sells, and then limit buys. There's going to be stop losses. So we can start with limit orders. Let's say you want to buy Apple, but not at the current market price of, let's say, around 165 bucks. But I'd rather buy it when it goes to 150 bucks, right? Because it's cheaper. I can set a limit buy so that my buy order only gets filled when Apple's price hits $150.
Before you continue, just for the people listening, what he's trying to say, the filled quantity and what he said when it only gets filled is basically you buying. It's like you bought it at that price. But yeah, go on.
Yeah, good clarification. Thank you. When it hits $150, my order is going to go through and I'll have bought X amount of shares that I specified for $150 instead of whatever it was before that I did not want it at. So this basically is going to ensure that I'm not paying more than I want to pay for the stock. And then on the flip side of that, you can do a limit sell, right? So let's say now I own this 100 shares of Apple at $150 a piece. And let's say I don't want the market to get too crazy and me to lose money. So I'd have a limit sell at $100. I'm willing to take a loss of $50 per share, right? This is hypothetical. I would never take that big of a loss. But anyways, let's say I set my
let's put
limit
you in the
sell at
positive.
100.
Let's put you in the positive. You're on a 10% increase. Let's do a 165 limit sell. Like if I've done that before, where I'll buy it at 130 or whatever, and I'm like, I'm good with 150. If it reaches that point, I want to sell it. You just throw it at 150. You make that $20 return. You're good.
No, yeah, 100%. That's right. So
Okay.
this
All right.
part goes
So let's
both
do it
ways.
that way. Let's do it that way.
Yeah. So Ramiz, you're right. You can use it both ways. Let's say on one side, let's say we bought the stock at 150, period. Now, if it goes up to 165, I could have a limit sell set at 165, and I will sell all my shares at $165. Now, I'm content with that profit. That's the level I want. I don't want to go big or anything. I just want easy money.
Or how many ever you want. You don't have to sell all. You could sell half and say, okay, I collected some profit and we're going on.
Exactly. But then the other side of the limit sell, if I wanted to not lose more money than under, let's say, $100 a share, I could have the limit sell set for $100. So once Apple hits below $100, it's going to sell my shares and prevent me from losing even more money.
Absolutely.
And then, yeah, like Ramiz, you were saying, the expiration dates, very important. So you could have this limit order expire in many ways. And by expire, we mean it's just not going to go through anymore after whatever set
You'll
time
still have your
period is.
shares.
Exactly. It won't go anywhere. So you could have it set to the end of the trading day, or there's good till canceled orders. That'll expire once I myself cancel it. So basically, as long as it's up there, it's going to stay active. And if it reaches whatever price point that was set, it's going to go. One of the benefits of a buy limit order is that the investor is guaranteed to pay a specified price or less purchase a stock. A downside, however, is that the investor is not guaranteed that their order will be executed, right? Because it's not guaranteed that the price is going to hit this point or that point.
Yeah.
Correct.
And Akshar, it's an interesting point, and we just talked about our Costco deep dive in the last episode. After you've done your margin of safety price, if you are investing in singular stocks, there may be a price at which you are willing to pay for Costco. There may be a set price where I've done my research. I think that the stock is worth this much. I don't want to buy that stock until it reaches there, but I also don't want to miss it if for some reason it goes down there and I'm just not looking at the market and then it goes back up. So that's a great time when you can say, hey, I want to purchase the stock at this 150 price, or Costco's not at 150, but let's say I want to purchase this at 150, okay? You can put a good till canceled, and that order is going to stay in there. It's going to stay there until it's either canceled or it's filled, meaning you end up purchasing those shares when the stock hits 150.
Time is money has a whole different swing when you talk about it with limit orders. It's almost artistic and poetic.
And then that same way, we can also put this to sell orders, where I can set a limit order to sell a specific price. An example, if I'm shorting a stock.
I think we're going a little too fast, but just for our listeners, you want to quickly do a refresher on shorting a stock?
Yeah, I'm going to pass this one to Mickey. I'm a little tired of talking now.
All right. I'll take it. So shorting a stock in itself is kind of a tricky concept, but I'll try to break it down as simply as possible. So the basic premise is that when you short sell, you're betting on the stock going down in price, and you're trying to make money on the stock going down in price. It seems counterintuitive. You think the only way I can make money in the stock market is by the stock going up. But a lot of people on Wall Street up in New York also make money on the downside too. So what you do is you actually borrow shares of a stock from a brokerage. You sell those shares of stock that you don't own. You borrow them, remember, and then you hope to buy it back later for a lower price. So what you do is I borrow those shares, let's say of Apple, 10 shares. I sell it immediately at the market price, let's say 150, and then I hope it drops to, let's say, $100. And then if it drops to $100, I can repurchase those shares at $100, return the shares that I borrowed, and then I made that $50 profit. The difference between that price I sold it for and then the price that I later bought it back for.
Mickey, wasn't there a movie made about this?
Yeah, The Big Short. Great movie. Fantastic movie. So for those of you who haven't watched it, it's about some people in New York who got really smart and shorted the housing market. So as I'm sure you might have heard, in 2008, the housing market crashed. So these guys bet on the housing market going down, made a bunch of money, and now they're probably off on some island in Fiji on their big yachts, living life while we're here, studying away for step one. So
Wait, are we telling medical professionals, are we advising them to watch a movie?
absolutely, watch the movie.
This is your homework for the next episode. Exactly.
A lot more listeners giving out movie homework.
Oh yeah, oh yeah. I take movie homework any day over studying, 100%. Oh, I did want to add though, to even be able to short sell, you have to have a margin account. So we talked about this earlier. Ramiz mentioned this, but because you don't actually own those shares that you sold, you're gonna have to pay interest on those shares because you're borrowing them from something. Borrowing anything costs money, especially from a brokerage. So the longer your position is, the more interest you'll have to pay. So that's something to be cognizant of, is that when you're borrowing the shares, you're going to pay interest on it. And the longer you have these shares, the longer it takes for that share to go down in price, the more interest you're going to have to pay. So, big disclaimer, this is an extremely risky thing to do because not only are you betting on the stock going down, you also need to have it go down within a specified time period. And often the market doesn't cooperate the way you want it to. Sometimes the stock will go up and then you're losing even more money. And so your losses, especially with stock shorting, are theoretically infinite. If I buy or short a stock and the stock price goes up, my losses could theoretically be infinite. The price could theoretically go to infinity. It's not going to go to infinity, but it could. So your losses can continue to accrue as the stock goes up.
Sorry, just on thought of that, wasn't that somewhat similar to what happened in GameStop
Yeah.
when everyone was buying the stock and people like the big hedge funds were shorting GameStop? So every time the price was going up, they were just required to pay a lump sum of money because they were shorting it and they had a margin account. Am I right?
Yep, that's exactly right.
There we go.
That's
There we
exactly
go. You
right.
don't want to be in that position.
That's exactly right. So those guys, as the stock started shooting up to the moon, as the Reddit guys called it, those diamond hands, those short sellers in New York, they were losing a lot of money as it was going up to the moon. They were not happy, so they had to take huge losses because of that. Whereas if I was just buying GameStop, my loss would only be limited to what I put in because theoretically a stock can only go down to $0. So just to recap, if I'm shorting a stock, the first thing I will do is sell the shares I'm borrowing on margin, hoping the stock price goes down, and I can then hopefully buy them back at a lower price. And then I can do this to minimize my losses or maximum, kind of set my profit in. I can use a limit price to sell it at the price I specify. So I can lock that in without having to always track what's going on, like Akshar mentioned.
Mickey, man, I know I said I was tired of talking, but I'm really even more tired of hearing you yapping on and on. So I'm going to give them a super easy example. I'm going back to my Apple at 150. If I bought the Apple at 150 and I wanted to sell some at no less than 175, I can put a limit sell order at 175 and it won't sell until those shares hit 175. Easy peasy.
Wow.
Honestly,
That big
that
deal.
was
That's
fantastic.
I know.
Akshar came in with a
I
mic
know.
drop there.
That's a mic drop
Thank
moment.
you.
Well,
Thank you.
I do want to jump in and Akshar, not to complicate your easy peasy, but I want to jump in and add that stop loss orders are another common terminology you hear about in the finance world. These came to my mind when we started talking about limit orders. So stop orders are basically fancy limit orders. So let's say I bought that Apple stock at 150 that you're so excited about. I can set a stop loss or a limit sell at 135 so that Apple dips below 135, my Apple stock will sell. MD, I think you talked about that a little bit earlier. But this allows this essentially
but go through it.
Yeah, so this essentially allows me to minimize my losses. So once that stock hits the price or the value that I set, my order gets turned into a market order, which means it's going to fulfill immediately at whatever that market price is, and it's going to get transacted immediately. So these are used widely by traders to limit their downside, so that if a trade starts to go against them, they can minimize the loss as to what they can tolerate. So very rarely are you going to use this if you're a long-term stock investor. We don't have a need for this short-term strategy, but for these short-term traders, they want to minimize losses, so they're going to do this a lot. If I see Apple go below, let's say 135, and again these numbers are arbitrary, right? I don't actually know, but if let's say the number was 135 and it went below that and I really liked the long-term possibilities of Apple, I would be buying the absolute crap out of that stock because I'm so excited I can get it for that low price. As long as that story hasn't changed and I don't think Apple's about to go bankrupt, I'm going to be buying the crap out of it. So I think that's important. I wouldn't be selling this theoretical stock that I own, but rather I'd be buying a significant amount more. So a stop loss order is not for everyone. However, it can be a powerful tool if you're a trader and you're looking to limit your downside on quick trades.
I just want to say for our listeners, they've heard so much. We've had an entire series, honestly. Thank you for sticking through with us. So just for our listeners, I want to do a simulation with you guys, a little hypothetical. Is that cool?
Let's do it.
I'm in, brother.
All right. Okay. So let's say I've decided to begin my trading journey and I buy stocks. I decided on the stock allocation breakdown I want and have now invested in ETFs, some individual stocks, and I've completed all my deep dives and my research so I can make informed decisions. Now that I've bought some stocks, what are some tips and things I should be cognizant of?
Yeah, I'll take that one. So you're going to want to watch out for fees. We've talked about this in prior episodes, but when you're trading, we're looking at mutual funds and ETFs. Look at the fee load. This kind of sounds like a fancy word, but essentially you're going to want to look for fees that are less than 1%. Most ETFs are going to trade much less than 0.3%. But what we have to be cognizant of is that the more fees we pay, the more our returns are going to be impacted. So compare fees on these various ETFs you're looking at. Quickly, I will get into mutual funds. Mutual funds are going to charge even higher fees. And what's important about that is if your returns are, let's say, 7% and you're being charged 2%, I mean, that's a significant portion of your returns being given away to someone to manage your money. So I want to add that in quickly. Just be cognizant of that. It's also important to know when you should cut your losses. So if we are long-term oriented, we're not going to get worried about short-term volatility, right? But if a stock moves negatively because of some significant change, like the company's struggling, there's new regulation that's going to affect their business, and your original thesis for why you bought that stock no longer holds true, it's going to be important to cut your losses and move on. That will be one of the most difficult things you will ever do, is sell that stock when it's low, when you used to think this company was such a great company. But things change, business changes. I mean, there could be some new iPhone that comes out that just blows Apple out of the water. And at that point, we might have to change our idea on Apple and sell that stock. Ramiz, what do you think?
Yeah, Brennan, that's a great point. For a long-term investor, as we all know, Brennan is a big proponent of long-term investing, his idol Warren Buffett.
Hey, I didn't bring
We
up
have to
his name.
consistently ask ourselves, for the first time, but we have to do it just for you. But yeah, I was saying for a long-term investment, we have to consider asking ourselves, how has the story changed for a certain stock? So let's take, for example, Costco. I think I have some numbers somewhere around here for when we did our Costco deep dive, but on the 21st of February 2020, the price of Costco was $321.95. But on the 28th of February 2020, just 7 days later, we had a knock down to $281.14. That's a pretty big margin of a loss. So if we're a long-term investor, we want to ask ourselves, why did that happen? Now, obviously at that time we had COVID going on, and that caused a lot of vulnerability. And in general, no one knew where the market was going. That's where the drop happened. But in many other scenarios, you can also learn about why a price would go down. For example, when the Suez Canal was blocked up and there was a shortage of chips, we saw prices actually go up since the supply was low and the demand was very high. In other case scenarios, you'll find multitudes of reasons why something may have gone up or gone down. But in general, as a long-term investor, you want to know what is happening to the price of a stock.
Yeah, one thing I did want to add in there, MD, is again, what you just talked about is a great example if you're individual stock investing. I mean, if you have Costco, if you're in ETFs or you're in a mutual fund, I would argue that you may never sell your stocks in ETFs until you're ready to get out of those. I mean, I guess if you were invested in like the tech ETF sector and you saw technology somehow coming to a grinding halt, which is, I don't think ever going to happen, you may sell. But in something like an ETF, if we see the price go down and you still believe in the long-term success of America, you're probably going to want to put more money in when the price goes down. But rarely are you ever going to sell based on the story of something, because there's so many companies, unless you see technology as a whole going down. Would you agree with that?
Yeah, absolutely. I think that goes back to your trading strategy, what your intent is, your purpose is, why you're investing the money in the first place. But everyone has their own motive on what they're investing in, why they're investing in, and you're absolutely right. If it goes down for a little bit for a week, you're not worried about it going down because you're projecting it for mass increase or at least a certain percentage of returns by the time you're, let's say, 55, 60, which is why they call it long-term investing.
That's the thing is if you're going to do these individual companies, you're going to have to stay a bit more on top of it than if you throw your money into ETFs.
Oh yeah, absolutely.
ride.
Divide the risk in ETFs. Think about a sector that you think is going to be great and allow the individual stocks in that ETF to take control of where you're investing.
Yeah, and I'll just add that it's just important to make sure that the thesis of why you want to invest in a company hasn't changed. Let's say something dramatically alters Costco's business model and you don't see it surviving long term, then there's a reason the stock went down and it might be time to get out. But if it's just white noise, making it volatile in the short term, like we said, just ride or die, keep riding out the wave and go long term. So,
Yeah,
with
we
that,
have Dominic Toretto out here.
yeah, we say we're all about family here on the Financial Freedom Podcast. So let's say you've done extremely well in the stock market, your family's super happy, and we're a bit further down in our investing careers. We want to make sure our money's adequately distributed. Akshar, can you tell us a little bit about rebalancing your portfolio? I know we mentioned that a little bit before.
Yeah, so rebalancing is referring to the process of returning the values of a portfolio's asset location to the levels that we had defined them to be in the beginning. These levels are to match our tolerance for risk and our desire for reward. And like we've been saying, I think in a few different episodes now, that's going to be different for everyone. But for example, let's say I had my portfolio and we had it split up 50% stocks, 25% real estate, and then 25% bonds to make my 100% of my portfolio. So now let's say the stock market had a crazy good year, and now all of a sudden my portfolio, the percentages of how my money is distributed is thrown off. So instead of my stocks being worth 50%, now all of a sudden they're worth 75%, right? So my other things are now worth that much less in terms of the total portfolio. Thinking of it as a big pie, right? The stocks are now taking up a big chunk of my pie. So to rebalance, I gotta get rid of some of my pie and I gotta have it filled back with the other stuff that is still in my pie that I want to be 50%, 25%, and 25%.
All this pie talk is making me real hungry. I mean, you have said pie like 12 times in the last 30 seconds. What is your favorite type of pie? I'm curious. Are you like a blueberry cobbler, apple pie?
No, I need that chocolate walnut pie.
Dude, gross.
No, that's crazy. Absolutely crazy.
Sorry to interrupt. Now I want pie. Keep going.
I mean, I will say ditto to the pie. I'm kind of feeling some pie right now. So let's wrap this thing up so I can go get some pie from Costco because, I'm super bullish on Costco pie. I did just want to add
Mickey, you getting some for the family though?
Oh, yeah, of course. We're going to get pecan pie, peach cobbler pie. We'll get some Warren Buffett pie for Brennan.
Get all of it.
Let's wrap it. One more thing to add. There's no one surefire method to stock investing. Everyone has their own needs, their own preferences, their own risk appetite, like we mentioned. The most important thing you can do is do your own research, practice with those online free simulators, and find a strategy that works best for you. Things may not always go the way you want. Some stocks or ETFs will go down in value against what you believe it will, and you'll lose some money. But that's okay. It's important to stay disciplined, do your research, and invest according to your strategy. Discipline is the main way you're going to make money long term. And most importantly, besides that, is to get started now. Most of our listeners, you amazing people, are in medical school or residency or just starting out as attendings. So the most important resource you have right now is your time. The earlier you start, the more time and power compounding will help you grow your wealth.
Yeah, I think that's a great way to close this out, Mickey. So as we do come to a close today, we hope this provided you value and insight. We're constantly working to improve, so send us your feedback. If there's any topics you want us to cover, please shoot us an email at financialfreedomandmedicine@gmail.com. With that, it's a wrap for today's episode. We'll see you on the next one. Study hard, y'all, and God bless.